The cost of your car, your house, and your credit card is all influenced by a single decision made today. This decision also affects the money in your savings account. It comes from the Federal Reserve, a group often surrounded by confusing jargon. But today, we're cutting through all of that. We're going to break down exactly what happened, why it happened, and most importantly, what it means for you. Forget the complicated charts. Think of this as a simple conversation about what the Fed's decision means for your money. So, what did the Fed do? They decided to hold interest rates steady. No cuts, no hikes. Now, holding things steady might sound like a non-event, but here's the signal. After cutting rates for the last 3 meetings, this decision to pause is one of the most important messages they could send. The key message today isn't about panic, it's about stability. This decision quietly tells us where the economy is right now, and what the Fed is waiting to see next. Let's get into it. So, what actually happened? A group of 12 people on the Federal Open Market Committee, or FOMC, met to check the health of the US economy. Their main job is to set a key interest rate called the federal funds rate. Today, they voted to keep that rate in a range between 3.5% and 3.75%. This was what most people expected. But what is this rate? Don't let the name fool you. It's simpler than it sounds. The federal funds rate is the interest rate banks charge each other for short-term loans. You should care because this rate is like the first domino. When it moves, it starts a chain reaction that eventually affects your credit card rates, car loans, and mortgages. So when the Fed decides to hold rates steady, it means they are pausing that chain reaction. After making it cheaper for banks to borrow for the last few months, they're now holding that cost steady. The first domino is standing still. The big question is, why? So why did the Fed hit pause? It comes down to their 2 main jobs, known as the dual mandate: keeping prices stable and keeping employment high. Think of them as trying to fly a kite. They don't want it to crash, a recession, but they also don't want the string to snap, runaway inflation. They want that kite flying smooth and steady. For a while, the economy was slowing, and the Fed was worried about the kite dipping too low. So they started cutting interest rates 3 times last year. This makes borrowing money cheaper, which encourages people and businesses to spend and invest. So why stop now? Because they're seeing signs that those cuts are working. Fed Chairman Jerome Powell said the economy is on firm footing. People are spending, and businesses are stable. At the same time, they're watching inflation, the word for rising prices. The Fed wants inflation around 2%. Recent numbers are closer to 2.7% to 2.8%, which is much better than it used to be. So what this tells us is that the Fed is in a waiting game. Cutting rates again could make inflation heat up, but not cutting rates could risk the recovery. They are waiting for more data. Think of it like a doctor who has given a patient medicine. Now the doctor is just watching and waiting to see if it's working before deciding on the next dose. Today's decision is the Fed saying, we think the medicine is working, but we need to be sure before making our next move. When the Fed votes, the number matters, but the disagreement matters even more. Now, here's a signal hidden inside the vote itself. The decision to hold rates steady was not unanimous. The final vote was 10-2. What this tells us is there's a real debate happening inside the Fed. The 2 members who disagreed, Stephen Moran and Christopher Waller, wanted to cut interest rates again. They're essentially saying, I see some weakness. Let's act now just in case. But the majority of 10 voting to wait sends an even clearer message. It signals that the Fed's leadership feels confident the economy is strong enough on its own for now. They don't feel a desperate need to rush in with another rate cut. This quiet decision shows cautious optimism, not panic. All right, we've covered the what and the why of the Fed's decision to pause, but the most important part is coming up next. What does this actually mean for your daily life, for your money? We're going to break down the impact on your savings, your debt, and the job market. If this kind of clear breakdown is useful to you, subscribing helps us keep doing more of it. Okay, let's connect this big decision to your actual bank account. How does holding rates steady affect you? Part A. For anyone who borrows money on credit cards, car loans, mortgages. If you have debt with a variable rate, like a credit card, you may have seen your rate slowly fall recently. This pause means that trend will likely stop for now. For big loans like mortgages, this hold signals stability. Rates probably won't keep falling for now, but they aren't expected to shoot back up either. It creates a more predictable environment. The takeaway is simple. The recent relief you may have been getting in borrowing costs is now on pause. Part B, for anyone who saves money. If you're a saver, you've probably noticed that interest rates on high-yield savings accounts have been dropping. Today's decision is good news for you. It means that decline in your savings rate will likely pause. The return you're getting from savings accounts and certificates of deposit, CDs, will probably hold steady for a while, giving you a break before the Fed potentially starts cutting rates again in the future. Part C, for the job market and your career. What does this mean for your job? The Fed's earlier rate cuts were designed to prevent widespread job losses. Now, the Fed sees the job market in a stable, though cooler, spot. Chairman Powell noted that while job gains are low, the unemployment rate appears to be stabilizing. It's a cooling, not a collapse. One reason he mentioned for this is a smaller supply of new workers, creating a better balance between open jobs and people looking for them. For the average worker, this signals stability. The Fed doesn't see an immediate risk of major layoffs across the economy. Part D, for investors and your 401k. The stock market is always looking ahead, and it hates uncertainty. So why did investors see today's decision as a positive? First, it shows confidence. A pause suggests the Fed believes the economy is strong enough to stand on its own. Second, it keeps the door open for future cuts if needed. For investors, this is a best of both worlds message. The economy seems okay, but help is still available if things weaken. Today's message from the Fed was one of calm confidence, and that's the kind of message that helps your 401k breathe easier. So let's bring it all home. Today, the Federal Reserve decided to pause and let the economy coast for a while. What this tells us is that their earlier actions seem to be working. The economy is solid, the job market is stabilizing, and inflation is getting closer to its target. For you, this pause means a moment of stability. Borrowing costs are leveling off, savings rates are holding steady, and the job market is seen as stable. In short, the Fed's message today was a vote of confidence. They believe the economy is on the right track, and now they are patiently watching to see what happens next. The big takeaway isn't confusion or panic, it's stability. Navigating this economy can be confusing, but it doesn't have to be. If this breakdown helped you out, make sure you're subscribed with notifications on. We'll be here to explain the next decision in simple terms, so you always know what it means for your money. Now, I want to hear from you. How does this decision affect you the most? Are you a borrower, a saver, or a home buyer? Let me know your thoughts down in the comments below. Thanks for watching.